Today, we're going to talk about optimizing an all-Indian mutual funds portfolio. This case study explores the concept of portfolio rebalancing and its impact on portfolio performance. We'll compare 3 allocation scenarios applied to a portfolio containing 4 popular Indian mutual funds from June 2021 to June 2024. To ensure our analysis reflects real-world market conditions, we will utilize DiversiView's strategy backtesting feature. This allows us to analyze the performance of the 4 chosen Indian mutual funds during this analysis period. In this example, we'll look at 3 popular approaches. Scenario A, equal allocation and hold. This scenario involves purchasing an equal asset allocation and holding the portfolio without rebalancing. In Scenario B, this scenario starts with an equal allocation in June 2021 and then rebalance to the optimal asset allocation with DiversiView in January 2022. This allocation is then held for the remainder of the analysis period. Scenario C is the optimal allocation every year. This scenario rebalances the portfolio to a new calculated optimal allocation using DiversiView each year in January. Some of the key differences in the 3 scenarios is that in Scenario A, buy and hold requires no user intervention, but allows allocations to drift from their original target. In Scenario B, rebalances to the optimal allocations once before it is held requires no further user intervention. In Scenario C, a more proactive approach of rebalancing to an optimal allocation every year, offering the potential for improved performance by factoring in market fluctuations. While it requires more specialized skill, there are tools like DiversiView that can help you calculate your optimal portfolio allocation. By comparing these pie charts, we can observe how the optimal asset allocation is adjusted year over year. This will provide valuable insights into how Scenario C actively seeks to optimize portfolio performance and increase expected returns. To compare all 3 scenarios, let's take a look at this graph. It reveals a compelling story about the performance of each scenario over the 3-year period, from the starting value of 100,000 Indian rupees. Scenario A, the buy and hold approach, achieved a final value of 1,059,200 Indian rupees. Scenario B, rebalancing to the optimal allocation once before it was held, resulted in a higher return over 3 years compared to Scenario A, with a final value of 169,500 Indian rupees. Scenario C, notably, the rebalance to optimal allocation annually achieved the highest value of 176,700 Indian rupees. This suggests that the dynamic rebalancing to the optimal asset allocation captured favorable market movements, ultimately leading to a higher portfolio value. For strategy B and C, transaction fees for buys and selling respective securities upon rebalancing were considered. DiversiView equips you with tools to make informed investment decisions, as showcased in this study, with optimal asset allocation, regular rebalancing, and portfolio backtesting. Don't leave your portfolio's potential to chance. Get a free DiversiView analysis today and experience the power of data-driven investing.